these are some of the craziest markets that we ever seen and experienced, and probably that people have navigated. Could you please talk a little bit about how you navigated those markets and what has changed in the asset allocation standpoint for your clients that you work with?
Um, well, I don't know that I've navigated them. I think I'm still navigating them as everybody else is. Um, yeah, look, the markets. I mean, if you take a long-term view of markets, they're not that crazy, right? You know, they look crazy if you look at them day to day,
Mm,
and I encourage people not to do that. I tell my clients, please don't wake up in the morning and look at CNN and look at the market movements because that's not investing. That's getting distracted. So in these markets, and when you say these markets, we're talking about, I guess, this year. So kind of in the COVID type environment. I think there's a few basic principles, and we talked about this in April, and I'd given you a checklist that I had put together for clients that just ensured you would go through some critical things. At that point, and it's changed, by the way, so the environment is different today than it was in April. In April, there was a lot of leverage. It's tanking. There were risk. People were getting margin calls. There was a real worry about what the year might look like. People were trying to disinvest and so on. Um, Things have stabilized from market standpoint in a lot of ways, right? In those days, I remember forecasts showing the S&P going down as low as 2,300. We're beyond that. It's been well over 3,000 for some time now. Um, and so the markets have stabilized to a certain extent. Um, what I have encouraged clients, and there's reasons for that. You know, part of it is what the central banks have done, which has been very important. Part of it has been the stimulus, and part of it is the fact that the markets don't reflect the economies. I mean, there's a big difference in the U.S. between the stock market and the state of the economy. Stock market is a snapshot of a small group of companies, large public companies that have fared reasonably well through not all of them, but many of them. And you know the markets are dominated by certain names like Apple, like Facebook, like Microsoft, and they've done well. And I've been happy to have clients' money in those securities, but it's not an example of the economy. So, in terms of what should you do, I think one is to stay invested. I know people that were trying to get out of the market and back into the market. I didn't advise that. I didn't think it was a good strategy because we can never predict when the markets are coming back. And if you look at any kind of time series, if you look at timing the markets, it's very seldom at an advantage to get in and out over the long term. You're much better off staying in the market. So that was one investment. I mean, money is cheap, so I was encouraging people to stay invested, and to stay in for the longer term. Secondly, to look at market in terms of which companies would tend to fare well. You know, Nasim Taleb has a wonderful framework around fragility. You know, what are fragile, what are robust, and what are anti-fragile. And that's actually been very helpful. And I've looked at that a fair bit as a guide as I've looked at things. So what things are fragile? Well, we've seen it. You know, hospitality, tourism, retail have been terribly fragile in this COVID environment. And so you've seen a lot of sell-offs there. What have been robust? Online businesses, technology business, certain healthcare businesses have been robust. They've stood up very well in there. And then there's some things that have been actually anti-fragile, so things like Zoom and things like Amazon, things like we could talk certainly about real estate, but there's certain areas like warehousing and things that actually do better if COVID gets worse, right? That's the definition of anti-fragile, that when things get worse, they actually thrive, not only survive. So I think when you think about investing, I think you need to look at these different categories and try to understand how fragile is my portfolio, how anti-fragile is it, and how robust. And then you can start to make choices. So that has been one big thing. So stay invested, don't sit in a lot of cash, don't try to time the market. Try to figure out how you can get to a place where you're more robust and anti-fragile. Yeah. And then there's another discussion, and again, this depends on the clients, but there's a big decision to make between going into some private investments, not just being in public markets. The public markets have been well bought, they're expensive. Um, and so one can definitely benefit, and I like to do this in portfolios, have some private investments, be they private equity, private debt, real estate, and hedge funds to a lesser extent. Um, and I think that's very important. Yeah, so that's been an important part of how I've looked at portfolios. And then, within the diversification, geographic diversification, because there have been benefits to, for example, I got into China in a bigger way a few months ago, and that's paid off well. I did it to diversify, but the market's done quite well.
Mm.
So those are the things. But I think the public-private for high net worth clients, for retail clients, it's not, but for high net worth is an important thing. I know UBS has been promoting that and talking about that, and I think it's a good thing clients should think about. I think Taleb's framework,
Yeah.
just to help you, is
Mm.
useful for a lot of things in life. It's useful for us to think about our own lives. I'm a big fan of his writing and his kind of models. And again, it applies very well to finance. You just have to apply it correctly. It can be misapplied as well, but it's very powerful as a framework.